Let's now start with the next chapter, which is about depreciation counting. Let's start with getting the word right. It is not depreciation. It's Depp. You know Johnny Depp? Like that. Depreciation. So what do you mean by depreciation? The definition of the word depreciation is given by Companies Act 2013 Schedule 2. How does it define? It says depreciation is systematic allocation of depreciable amount of an asset over the useful life of the asset. Let's go slightly away from depreciation to understand depreciation slightly better. If in case I want a machine in my business, I don't have enough money to buy the machine. What do? I take it on rent. If I want an office space to function my business, but I don't have enough money to buy the office, what do? I'll take the office space on rent. I'll take the factory on rent. I'll take the machine on rent. I'll take the motor vehicle on rent. Using all of these assets, I will generate revenue. That revenue will come on the P&L statement credit side. The expense, that is rental, will come on the debit side. I'll match rental expense with the income that I earn. Net profit would come. Basically, matching concept what we learned yesterday. Remember matching concept? We need to match current year expenses with current year income to arrive at current year profit or current year loss. So we all know rent is an expense, P&L account debit side. Using that machine which we've taken on rent, if we earn revenue, revenue will be income, P&L account credit side. If I buy the asset, it is capital payment. It is no longer revenue payment. Remember, whenever the payment is made based on the nature of the business, purpose, recurability, materiality, revenue generation capability, it will be categorized as capital payment and revenue payment. Revenue payment, P&L account debit side, rent paid for using the asset. But full amount paid to buy the asset will no longer be rental expense in P&L. It is capital payment. Where do you write the amount paid for purchasing the asset? Balance sheet, asset side. Asset is sitting in balance sheet asset side. From that asset, whatever income you are will come in your P&L account credit side. So there is income, there is no expense. So full income will become profit. That's where we are not following matching concept. If you buy the asset, will you write the asset in P&L account debit side or balance sheet asset side? You write it in balance sheet asset side. Using that you earn revenue. That will come in P&L account credit side. Matching expense is only not there. Full sales amount will become profit. Is it right? No. What are we not following here? Matching concept. Now, let me give you a statement which I want you all to think and then remember for life. Whenever you take the asset on rent, it is expense. Whenever you buy the asset, it is several years rent paid together. It is several years rent paid together. I can buy a bike by paying 1 lakh rupees. I can take the bike by paying 10,000 rupees annual rent. If I pay 1 lakh rupees and buy the bike, it is just 10 years rent paid at once. It is just 10 years rent paid at once. This is the ideology that we should keep in mind to ensure that we understand depreciation from the scratch. So that entire amount that you pay will be an asset because it is deferred expenditure. Treatment is like deferred expenditure. Part by part, I go on transferring that asset to P&L account so that the asset gets closed at the end of the useful life. If I don't do this, I purchase the asset today, I write 1 lakh rupees in the balance sheet asset side. One fine day, all of a sudden it becomes zero. It doesn't become all of a sudden zero, no. It will slowly, gradually decrease and then it will become zero. 1 lakh will become 90, 90 will become 80, 80 will become 70, 60, 50, 40, 30, 10 and then zero. It's not like it was 1 lakh, it suddenly became zero. That's not how it is. So that's the reason we depreciate an asset. It is systematic allocation of the depreciable amount of the asset over its useful life. You buy an asset for 1 lakh rupees. Useful life of that asset is 10 years. 1 lakh will be returned to P&L account over 10 years. 10,000, 10,000, 10,000. Depreciation. Here we have a beautiful word which I have underlined. What is the word that you see? Depreciable amount. What do we mean by depreciable amount? You bought the asset for 1 lakh. That does not mean asset has to be depreciated by 1 lakh. Why? You paid 1 lakh to buy the asset. At the end of the useful life, if you sell to the scrap dealer, he's going to give you 90. So he's going to give you 10,000. When you bought the asset, how much money did you pay? 1 lakh. At the end of useful life, when you sell, how much do you get? 10. So your usage is only 90. 1 lakh what you gave, in the 10,000 you got back at the end of useful life. So your depreciable amount is 90,000 only. That's the reason when you compute depreciation, you use the formula original cost minus scrap value divided by useful life. Total depreciation will be depreciable amount. Total depreciation over the entire useful life will be depreciable amount. How to write it in each year? How much to write in each year? That is the method of depreciation that we decide later. Focus on the keywords that we should know. Why do we provide for depreciation? There are several reasons. Number one, wear and tear. Akaladu, ariyadu. You wear it, you tear it, asset will get depreciated. But the depreciation, you might have heard that it starts when the asset is ready, not when it is actually put to use. This is because wear and tear is one of the reasons for depreciation, not the only reason. If the asset is ready, but you don't use, still it depreciates. Why? Obsolescence or effluxion of time or change in trend, change in technology, decrease in market value, consumer preferences changing. All of these are the reasons why the asset will be depreciated. You bought one asset, you don't use, you keep it idle. In spite of that, the asset value will come down. Why? Effluxion of time. Time decreases value of items. Get it? Same with obsolescence, outdated technology. A better technology is there in the market. iPhone 17 comes, iPhone 16 value drops. iPhone 18 comes, iPhone 17 value also drops. Right now, people feel young, energetic, and like, hey, I am the most youngest person. Yeah, give 2 years time. There are people who are more younger than you. Oh, then you are old. You get outdated. Sir, I am not. Yeah, how old are you? Like, I am 18 years with 12, 13 years experience. Yeah, after one point, you stop aging. All thanks to people like you. I even know what is 6, 7. Not many people who are 2, 3 years younger to me know it. Let's proceed. You understand why depreciation? Okay, jokes apart. Yeah, I am very old. Yeah, full white hair. Today only I put dye. You see here, little bit of skin also. It's become black. Morning urgent alarm. Then we'll discuss objectives. What are the objectives of providing depreciation? If you don't depreciate, asset will be shown at original cost in balance sheet. Nothing of it will come in P&L. Asset 1 lakh balance sheet. P&L account debit side, nothing. If you sell and get 10,000 revenue, full 10,000 profit, there is no matching concept. You're not matching. Your profit will become incorrect. If your profit will become incorrect, no, then your decision making also is incorrect. Let's say someone is dropping me home. He bought one bike for 50,000 rupees. I'll say I'll pay you petrol fee 100 rupees, you drop me. Petrol I'm paying, but bike value also will depreciate. No, I need to pay for that also. So you won't just pay the revenue expenditure. You also need to pay the recovery of the overhead that is incurred on the asset. So if you don't provide depreciation, the income that you compute will be incorrect. And if you don't depreciate, 2 years ago you bought the asset. Will the asset be still at 1 lakh? No, the asset value will decrease. So the balance sheet position of the asset also will be incorrect. And with this wrong data, what happens is you don't provide for any funds for replacement of the asset. And this will eventually lead to non-availability of cost of production, which will not let you know how much profit to book and which will not let you decide how much the sale consideration that you should charge. So the objectives of depreciation is correct financial statements, that is both income statement and position statement, identifying the cost of the production so that you can fix the selling price based on the profit required and also arrange for funds for replacement. Every time you record an asset of 1 lakh depreciated by 10,000, you reduce it to 90,000. You will know that 10,000 rupees there is depreciation, no, profit will decrease by 10. If not, let's say 1 lakh rupees asset you use, you make 20,000 sales in the current year. You think full 20,000 is profit, full 20,000 you will give as dividend or drawings. When you write depreciation 8,000, profit will reduce to 12. So though you have 20,000 cash in your balance sheet, you cannot use full 20 because you know 8,000 is an expense, but it is non-cash expense. This will stop you from using full money. This will let you accumulate the money. When you go on accumulating the money, by the time that 1 lakh rupees asset becomes zero, you will have enough money to buy a new asset. To buy a, I hope you understood. Fantastic. Let's proceed. The next point that I wanted to know is on what is depreciation charge? Depreciation, can it be charged on sundry debtors, inventory, investments, bills receivable, cash, bank? Tell no on what? Fixed assets. I want you to tell on what will you charge? Fixed assets. Fixed assets is an old word. 90s, millennials. Come on, Amma, Gen Z. What should you tell? It's not fixed assets. It is called PPE. It's called property, plant and equipment. Previously, there used to be a standard by name Accounting Standard 10, which talk about fixed assets, and there was Accounting Standard 6, which spoke about depreciation. Both of them are replaced with one brand new Accounting Standard 10, which is already 10 years old. No, easily 5, 6 years old. This Accounting Standard 10 is now called as PPE, property, plant and equipment. I hope you got it. What do you mean by a property, plant and equipment? It is a tangible asset. It should be tangible. It should have physical existence. But if it is intangible, that is intangible asset. For PPE, it should be tangible asset. Sir, don't we depreciate intangible asset? We depreciate them. But there it's not called as depreciation, it is called as amortization. But the treatment is completely same. This unit anyways will be discussing depreciation and amortization. So it's a tangible item. It should be held with one of the four purposes. Number one, to produce goods. Number two, to give services. Number three, to use in administration or to give it in rental. Now, I bought one laptop. It is used by connecting it to the machine. I connect this laptop to the machine, and using this laptop, I run the machine. So that is used in production of goods. Used in rendering services means I'm a chartered accountant in practice. I use my laptop to send mail to client, to analyze the data, to prepare financials. It is used in giving services. The third point is rental purpose. What I do, I buy laptops, I give it on rent, and I earn rental income. It's my third purpose. Fourth one, I use a laptop in administration purpose, meaning you might have seen one laptop in the classroom teaching. This is used to give service. In the accounts department, in the reception cabin, in the technical team downstairs, when you see, they also have one laptop. They also have one PC. They use that PC to administer everything that is going good or not. So, an asset which is used in production, an asset which is used to give services, asset which is used for rental purpose, as well as the asset which is used in administration, all of it will be called as property, plant, and equipment, provided it is tangible. And the next point is its useful life is greater than 12 months. It is useful for a period greater than 12 months. Come on, quickly read PPE definition. PPE is a tangible item held for use in production, use in rendering services, rental purpose, and administration purpose, and expected to be used for a period greater than. Yeah, you understood the definition of property, plant, and equipment, everyone? Let's proceed. Now, after we know the definition, you understood the reason why we should depreciate and everything. Now, I want you to know what are the things that will influence depreciation. Depreciation is not same on every asset. Depreciation is dependent upon certain things. Number one, it depends upon the cost of the asset because cost of the asset is only depreciated over the useful life. So cost is split and then written over the useful life as depreciation. So the first influencing factor is cost. The second influencing factor is estimated useful life of the asset. You bought one asset for 1 lakh. If you estimate the useful life for 10 years, you write 1 lakh over 10 years. If you estimate the useful life to be 3 years, you write 1 lakh over 3 years. If you estimate the useful life to be only 2 years, you write 1 lakh over 2 years. Depending upon number of years, depreciation value changes. And the third and important factor is residual value. What if I buy an asset for 10 lakh rupees and its residual value is 10 lakh rupees and my useful life is 5 years? I actually will not charge any depreciation only. Why? I bought it for 10 lakh. Residual value is 10 lakh. So I bought it for 10. After 5 years, I'll sell it at 10. There is no decrease in the value only. So there will be no depreciation. You will do this in CA Inter when you come. Lot of times you get government grant and several other things. You might buy the asset at concessional price. In such case, you will not provide any depreciation on the asset. An asset is already recorded at the residual value. That's a point at which you stop depreciation. We'll discuss at large when you come to CA Inter, Advanced Accounting, Property, Plant and Equipment. For now, all that I want you to know is these are the three important factors which will decide depreciation. What are they? Number one, cost of the asset. Number two, estimated useful life. Number three, number one, cost. Number two, estimated useful life. Number three, whether you follow straight line method or you follow written down value method, production units method, sum of your digits method, depletion method, whichever method you follow, these three are important. These three will be available. This is not only for SLM. Misconception is SLM we have to compute, sir, original cost minus scrap value divided by useful life. WDV, they'll only give percentage. No. WDV also the percentage is computed using this one. Let's quickly see. So the cost of the asset will include three important things. Number one, purchase price. When you purchase the machinery, when you purchase the asset, when you purchase the PP, whatever you pay is purchase price. I have 2-3 cute questions. Can I ask? Sir. Now, on the purchase of this asset, in the invoice, they've charged me GST. You know GST? Good and sweet tax, goods and service tax. GST, goods tax is being charged. Should I include the GST amount in the cost of the asset for depreciation? Should I exclude the GST? To tell 1 lakh is the cost of the asset, 10,000 rupees is GST charge. I paid 1 lakh 10,000 to buy the asset. Now, when I'm computing depreciation, should I compute depreciation on 1 lakh or 1 lakh 10? Depends whether input tax credit is available or not. When input tax credit is available, I will write PPA account debit 1 lakh. Input CGST, SGST account debit 10,000 to bank account 1 lakh 10. What if input tax is not available? Asset account or PP account debit 1 lakh 10 to bank account 1 lakh 10. If input CGST, input SGST is available, that GST amount will not be included in the asset. If input is not available, then that input CGST, SGST is not available. No, Write that also in the cost of the asset only. Full 1,10,000 will provide depreciation. I hope you understood. Same thing we discussed in inventory also. Okay, I've got a special request. You guys told me that you want me to discuss that GST part in detail. We'll not keep it as a part of our marathon, but we'll keep it as a separate discussion. We'll do that because I don't want to make marathon unintentionally being stressed on one specific topic and made long. So we'll discuss that GST based journal entries as a separate set video. We'll get it in the same channel. You can watch it separately, but not part of this video. Proceed. Directly attributable cost. After you buy the asset, till the time the asset is ready to be put to use, you will incur several expenditure. To buy the asset, you might have to go inspect the asset, that inspection expenditure. You might take some expert suggestion, professional advice, which asset to buy, that one. Once you buy the asset, you can't bring the asset and then install immediately. You need to disassemble the asset, pack it, load it, octroi, carriage, and then once it comes to the city where you are, unload, unpack, assemble, engineering cost, site setup cost, installation cost, trial run cost, trial run material, trial run labor, trial run overhead, all of this cost till the time the asset is ready to be put to use. Remember, ready to be put to use, not actually put to use. Till the time the asset is ready, any expense incurred will be added to the cost of the asset. Once it is ready, you should stop. Asset is ready to be used in January, but you decide to use the asset from April. February and March, time is not good. Stars are alignment is not good. So you're postponing. Those 2 months, if you pay some rent, if you pay some maintenance, if you pay electricity, can you include that in the cost of the asset? No. That should be charged to P&L. So the expenditure till the time the asset is ready to be put to use should be charged to the asset. So this part you understood. Then estimated cost of dismantling. This you don't have it in foundation. But I can just tell you one line which is not important here, but you can just know. At the end of the useful life of the asset, you might have to remove the asset and then give it. Now, asset is installed in the ground, 3 feet deep I've dug, and then I place the asset, put cement to brick, nut to bolt to tie to everything. After 3 years, I can't do like this. I would have to uninstall, no. Uninstall also, I would have to bring laborers. They would have to take, they should do, and then open the nut and then remove the asset. Asset I can't lift and throw like this. I need 5 people to hold, lift, and keep it outside. And I keep it outside, BBB people will not take. This is not Asi Kasana, Ona Kasana. No, this is not Kasa. They will not take. You need to disassemble this machine. Corrosive material, non-corrosive metal, electrical filling, wood, and then biodegradable, non-biodegradable, chemical waste, and then radioactive element if there is any. So you need to segregate that and discard it separately. This expenditure should be incurred when at the end of the useful life. 10 years you're going to use the asset. 11th year you'll spend the money. You need to identify how much will you spend after 10 years. Estimate it. You know time value of money? Discount that money to today's date and add it to the cost of the asset and depreciate it. If you bought the asset for 10 lakh and after 10 years of useful life, if you're expecting to incur 1 lakh, that 1 lakh's present value also should be added to 10 lakh and you should depreciate the asset. We'll do detailed problems based on this in intern. But right now, you just have to know that cost of dismantling that will be incurred at the end of the useful life of the asset should also be included in the cost of the asset.